And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the second best day of the week. Of course, that also means that Michael Leibowitz joining me this morning to talk a little bit about something. I mean, nothing really happened yesterday of any consequence. I mean, I kind of snoozed through yesterday. No, of course, the Fed meeting yesterday. We'll get all into what he said, what he didn't say, kind of what the markets are expecting now. But, markets did rally very nicely yesterday. And as we talked about yesterday morning, we said that, the market would rally if, kind of the hint was that, he was going to cut rates in September. Markets rallied into that meeting, and then pretty much kind of as we said yesterday, nothing really new out of the meeting, which is kind of what we expected. And the market just kind of flatlined. It was sold off a little bit initially and then just kind of rallied a bit into the afternoon, closed about where it was. So again, overall the action was good. It was a very big day for the markets yesterday. NASDAQ up almost 3%, but not really so much for the Fed. Of course, that was part of it, but a big chunk of it was the news from AMD, of course, and the kind of the new view by Congress or by government on ban of chip sales of companies that are friendly to the U.S. So that kind of relieves some of that pressure off of companies like AMD and NVIDIA that might have been, kind of involved in this chip ban, gave them a little bit of breathing room. So that led to a fairly decent rally in the SOX index yesterday. Now, of course, that has had the SOX index itself, which is the Philadelphia Semiconductor Index, has had a very, very big sell-off. Now, I've got some charts of this in today's daily market commentary. So if you go to our website, realinvestmentadvice.com, click on Insights, Daily Market Commentary. First article today, I have a couple of charts in here about the recent sell-off in the SOX index. That index sell-off, that degrossing, was rather dramatic and occurred very quickly. And of course, when everybody kind of sells at once, which tends to happen, that typically sets things up for a decent reflexive rally at some point. And so again, that's kind of why we saw a bit of buying yesterday. People kind of got off onto the wrong side. Some decent news from AMD yesterday that caused a bit of a market rally. This morning, now remember, part of this narrative has been that AI is dead, right? There's no application for AI, there's no need for it, whatever. And of course, that's been, kind of weighing on these AI stocks as of late. Way too early to say that. I mean, we're way too early in this game to say there's no viable use for it, right? So that's going to come. And right now, companies are still spending a lot of money to build out data centers. I talked about yesterday, Tesla spending, wants to invest another $5 billion into XAI to build out more data centers. That is still growing. The U.S. has the largest growth in data centers anywhere in the world right now. So again, there's, it's early to call that race. So again, I'll be a little bit careful with that. Yesterday, Meta announced earnings after the close. Of course, that's the old Facebook, and had a big surge in revenue and ad spending, giving some credence to the whole AI spending story. That stock, Meta's going to be up fairly sharply this morning. Disclosure: we do own Meta in our dividend equity model. It's our equity growth model. So, that's going to be up fairly sharply this morning. That's going to also add to these other AI stocks potentially. Today, we have Apple reporting after the bell, so we'll see what they say as well. So again, this has been a very big week for earnings overall. As we've talked about before, by the end of this week, about 80% of all the S&P 500 will have reported. On that front, earnings have been okay. Yes, we beat earnings, but only because we lowered the bar so much. But yes, we're beating earnings. But the rewards for beating earnings have not been fantastic. We're not seeing, stocks open up 20 and 30% like we had seen coming out of the pandemic. Now these are more kind of normal openings where stocks are up 4, 5, 6% at the open after they announce good earnings. But again, Meta will be up very nicely this morning based on that report. That's going to feed over into the NASDAQ as well, lifting that market up a bit. And that's what I want to talk about before the bell this morning is that, first of all, the sell-off in the, again, we've talked about for the last month or so that the markets needed to have a correction and that we were going to get a 5 to a 10% correction somewhere along the way this summer. And that's what happened. We got this correction. That was only about 3% so far. And we're about to move into the month of August. Month of August tends to be okay, but in election years, it tends to be a little bit on the weak side. September tends to be, seasonally speaking, the weakest of the month. So again, we've had this initial sell-off in the markets, which really kind of woke a lot of people up. We saw a big rotation in the markets. But if you take a look at the NASDAQ as an example, so this is the triple Q, right? The NASDAQ ETF. And we go back and look at periods where the markets had gotten this oversold previously. And again, we talked a little bit about this yesterday, but again, this is today's commentary. We're kind of at that point to where a reflexive rally is going to be much more likely. And again, we kind of see these same periods throughout history when we get to these low points. And again, these don't always necessarily correspond with big sell-offs in the markets, but when we've had bigger sell-offs in the markets, we've had bigger reflexive rallies. So again, we're just kind of set up right now, as we discussed yesterday, for this kind of reflexive rally in both these kind of large cap tech stocks as well as in the semiconductor issues as well. So again, kind of that rally, that regrossing that we saw yesterday. We had that big sell-off, so hedge fund managers were really kind of degrossing their book. They were very long, large cap S&P 500 companies, very long semiconductor stocks. That was the trade running up into this sell-off. They were short small cap and mid cap stocks. So that degrossing led to that massive, very quick rotation that we saw in the markets over the last couple of weeks. We've now gotten to the point now that they're underweight those same holdings. These better than expected earnings are going to lead them to start kind of grossing those things back up on their books to get them back into positions where they want to be. So this could lead to a bit more of a rally here in the near term. So again, kind of seeing this market rally up a bit won't be surprising. Now, importantly though, let's shorten this window just a little bit here. This rally has continued. This is, over the last year, we've had this very strong rally holding right along this 100-day moving average, just tested that 100-day moving average, coming off of that. So we have a successful test of that 100-day moving average, which is also kind of this running trend line of the market as well. So again, just from a bullish narratives, the bull trend remains intact right now. Again, oversold on a couple of levels here. So expect this rally here. Now, having said that, I don't think that we're going to go straight back to all-time highs. Now, we could. Anything is possible in this market, so you never discount that. But I think we've got some more work to do here, potentially going into the election. We're about to really start ramping up with the election. The rhetoric's already starting between Harris and Trump. So this is going to lead to a lot of debates going on about the markets. Wouldn't be surprised here to see the markets be a little bit more cautious heading into the election. And again, while August may be a bit sloppy, may see a rally here back up towards previous highs, could certainly be the case. I'm not discounting just yet that we don't see another potential corrective opportunity in September, October before the election, which will probably provide a better overall entry point to add exposure for coming out of the election. But again, I think there's a tradable opportunity right here. But again, just want to be a little bit cautious. We're in the middle of summer. We're pre-election year. This is going to be one of those things where we could see a little bit more volatility and volatility kind of pick up overall. So remain cautious, but don't be scared of the markets. Again, I think there's a tradable setup here for a bit of a rally in the short term. That's what you need to know before the bell this morning. We'll come back, pick up with Michael Leibowitz, talk all about the Fed, what that means for the markets, for bonds, all that coming up next on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Of course, Michael Leibowitz joining me. Of course, yesterday, the FOMC concluded their 2-day meeting for the month of July. They announced their policy decision, which was to leave rates unchanged, which really was not a surprise. There was a very small marginal chance of a rate cut yesterday, but for the most part, the vast majority of people did not expect a rate cut yesterday. So it was more about the language than anything else. And so for that, let's bring in Michael Leibowitz, talk a little bit about what he said yesterday, because I was snoozing during the press conference. I'm teasing. But Mike, what was your takeaway from the kind of just the press conference yesterday? Really, it didn't seem to be anything surprising.
It actually was a snoozer. And I actually blame a lot of that on the press, because the press asked the same question over and over and again. Why didn't you cut in July? Are you going to cut in at the next meeting in September? And truthfully, he kept, instead of addressing the fact that they kept asking the same question in different ways, he kept answering it and basically saying the same thing over and over again. And essentially the gist of what he was trying to convey, and what they made a few changes to the statement, which over the last few meetings, they really had made almost no changes. So that was a little difference too. Basically, he said that the risks between labor and price and inflation are equal now. And those are their two mandates. It's maximum employment and stable prices. So he's saying that we're looking at both inflation and prices in the same as equals now. Prior to that, and even at the last statement, they acknowledged that inflation was the bigger problem and the one that they would address. So they raised rates, trying to get inflation down. They're now, according to what Powell told us yesterday, very comfortable with inflation, and that it will continue to track lower. And I think this is important. Someone asked the question, are you more comfortable today than you were about a year ago, when it was also declining before it kind of got held up there for about 6 months? And he said, yes, we are more comfortable. There are sturdier signs that this round of inflation is going to keep falling versus what we saw about a year ago. So they're very comfortable on the inflation front, and they're starting to get a little concerned on the employment front. And I kind of paused there a little bit, because the employment numbers are fine. They're normal. They're getting back to normal. He basically said the labor market has finally normalized. He made a statement, something to the effect of, we're back to where we were on the eve of the pandemic. So the labor market, which can feed inflation, is back to where it was. Prices they're getting more and more confident prices, which are at 2.6, the core PCE, are going back to 2. And accordingly, he didn't say they were going to ease in September, but he pretty much set the table and put out the wine bottles. And barring an uptick in inflation or really strong employment numbers, they're likely going to cut by 25 in September.
So, and that kind of brings up a good point, because he has the employment numbers for Friday, which tomorrow morning we'll get the latest employment report for the month of July. But he already had that number. So if there was a concern there about employment being a whole lot stronger on Friday, he probably would have alluded to that maybe in some form. But probably since he says, hey, we're kind of back to where we were pre-pandemic, it's probably going to be maybe an employment report in line, maybe a smidge better than expected. But definitely not worse than expected, where he might have been more concerned about a weak labor market.
I would actually kind of argue the other way, because if it was a weak number, and again, not a terrible number, but just like ADP was plus 122,000 jobs.
Right.
So if we have a number like that, plus 125,000, 100,000, that's historically slightly weak. It's not the end of the world. We still added 120 something thousand jobs in that case. That would they would ease at the September meeting on a number like that. So I think what he was able to do is say that if things continue to happen, we will ease. Now, if he knew the number was bad, he pretty much in his head is saying we're going to ease, but he doesn't have to say it out loud.
Right. And
it buys him another 2 unemployment reports and 2 inflation reports in which they could change their mind without upsetting the market. So. Correct. It may have been a astute political move. Who knows? But
but speaking
go
ahead.
I was just going to say it's certainly based on all his comments. It appears that they're ready to ease in September.
Yeah, and look, the trend of the data is clearly pointing in that direction. I was just going to mention that I just posted a chart on our Twitter page this morning at Lance Roberts. Showing the Trueflation Index, which is the real-time inflation index. That's now down to 1.5%. So in Trueflation on a year-over-year basis is down to 1.5%. That's below the Fed's kind of 2% target rate. We're seeing inflationary pressures kind of recede on a lot of different fronts. The employment cost index was down a bit. We're not seeing real wage growth pressures at this point. And year-over-year wage growth is declining. I've got an article coming out tomorrow morning talking about the SOM rule, and in that we look at wages as part of that, and wages for the bottom 80% of workers. Once if you look at the bottom 80%, strip out the top 20% of supervisory workers, and look at the bottom 80%, their wages are weakening rather rapidly here. And so again, there's not a real risk of wage inflation, and we're seeing prices on different fronts. And of course, the biggest component of that is the homeowner's equivalent rent, which is also declining and looks to be declining further because of the big lag that's in that index. So there doesn't seem to be a lot of inflationary pressures here at this point either to concern the Fed.
Yeah, and I think the job numbers we have seen this week, the JOLTS and ADP number, talk to a labor market that's kind of like the real estate market, just stuck. No one's getting fired, no one's getting hired. No homes are selling. No one's buying homes. It's the same thing. So it's a very stagnant market waiting to break. And break, I could mean people start hiring a lot more or they start firing. So I think some of that has the Fed a little concerned that there is some labor hoarding. And if conditions just erode slightly, employers are going to say, you know what, we just need to let go. This employee hasn't been doing much, but we held him on thinking that business would get better. It's clearly getting a little worse. Mm-hmm. Let's lay off some people. So
it's kind of like we do with you.
Exactly. Exactly. I keep waiting. That's why I don't answer my phone.
But that is right. I mean, we are starting to see employers, they're not, again, to your point, they're not firing workers to a great degree, but they're also not hiring workers to a great degree. And some of the hires that they're doing, are very minimal, and temp hires, which is the first area you would expect to go during an economic slowdown. So the first thing I stopped before I start firing my full-time employees, I stopped hiring part-time workers. And we're seeing that decline increasing pretty sharply now as temp hires are really starting to drop off.
And the hires rates in the ADP report, which came out yesterday, was the lowest it's been, forget the couple months right after the pandemic started, but it's the lowest since about 2013, 2014. So clearly no one is hiring. They're just not firing. And that's why these labor numbers look good. Also, if you look at like leisure and hospitality and some of the other employment sectors that were growing 300,000, 400,000, 500,000 jobs a month, they've all but come down to like below 50,000. Some of those leading sectors are actually shrinking. So those high growth post-pandemic beneficiaries are no longer hiring either, and that's what was driving the very strong labor market.
So again, this is going to be interesting because again, the market responded, well yesterday. And the market really kind of expected. The market kind of rallied all day into the meeting, and then really once the announcement was made, really not much of a change. Had a little bit of a brief moment of a sell-off when he first started speaking, and then market rallied after that. But again, so it was pretty much built into the markets. But again, a lot of yesterday's rally was also on kind of a relief from AMD reporting better than expected numbers on the semiconductor side, which has already been under a lot of pressure. Today, the market's pointing up a bit, about 27 points on the Dow. NASDAQ's up about 121 points right now. So that's just, and that's on the back of Meta's news. So Meta, of course, reported earnings last night. That was better than expected. So we are starting to see a little bit of relief from this kind of recent sell-off, and then gear that with, kind of this hope for Fed rate cuts. The Fed funds futures now have ticked up to 3 rate cuts this year, which ironically is about where we were 1 year ago. At this time, we were at 3 rate cuts. So we were from 3 rate cuts to 6 to 0 back to 3. So we just kind of round tripped it in 12 months.
Yeah, but keep in mind, the Fed really didn't budge, right? They were always at 2.
Yeah.
So the market was moving all over the place, but the Fed was kind of at 2. So, the Fed's right now telling you that they're probably going to cut in September, and then the election becomes an issue. And will they cut before the election, or will they wait? So, my guess is they'll cut 1 to 3 times this year unless things really deteriorate. The big question will be how much do they cut next year, and what is, from an investment perspective, what does that mean for stocks and bonds?
Well, and again, I want to talk a little bit about that when we come back from the break. Bonds had a decent day yesterday, and very quietly, yields have been falling over the last 4 months. So as of the end of July, we've had 4 months of gains in bond prices. Yields have declined for almost 4 straight months, one of the longest stretches we've had now in a couple of years. With the Fed now starting to cut rates, or at least getting ready to, what does that mean here for yields, and what's the outlook, going forward into next year? We'll talk about that with Michael Leibowitz when we come back from the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Now, I warned y'all about the chat rules. Our chat member, Jerome Powell, says that I'm old enough to remember when we used to use well oil for fuel.
Those are fighting words.
The Real Investment Show podcast.
Them's fighting words. But more importantly, what Jerome Powell doesn't understand is that I remember when we had to catch our own whale.
And then turn it into oil.
And then turn it into oil for fuel. So, I mean, that was back then when men were men.
We liked it.
At realinvestmentadvice.com.
Had blubber for days.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. Of course, after 3 years of a bear market in bonds, is it finally over? That's kind of the big question that people have. Of course, this is one of the this is the longest stretch for bear markets and bonds going back to 1790. So it's very unusual for bonds to have more than 2 years in a row with negative returns. 3 years in a row has been, has not been seen before. So is that bear market in bonds finally over? Well, over the last 4 months, yields have been continuing to decline as economic growth slows, inflation declines. Of course, that is the very drivers of yields are economic growth, inflation, and wages. All of those declining, so yields decline as a function of that. So yields are just a reflection of economic activity at the end of the day. Economic activity, inflation drives yields. There was a lot of misconception that yields kind of just operate on their own, and because of the debt, yields are going to go up, and that's simply not how yields work. But yields are finally starting to come down to some very important levels, flirting with that 4% level on the 10-year Treasury. A break below 4% sets up 3.8 pretty quickly. That's going to start to feed back theoretically into mortgage rates. That could help the mortgage market as well, and the housing market stabilize a bit. So again, there's certainly some push here as people who have been out of bonds here for a while now starting to try to figure out how to get back into them. And again, so when the Fed cuts rates historically, yields fall because the Fed controls the short end of the curve. So anywhere from 0 to about 2 years in maturity is pretty much controlled by the Fed funds rate. Once you get into 10-year and 20-year and 30-year durations, that's pretty much controlled by economics. But they all do have a relationship with one another. And of course, this also goes to talk a little bit about the yield curve inversions. We're now starting to see the 10-year, 2-year beginning to get very close to uninverting. That's historically been a sign of weaker economic activity when that uninversion happens. It's not the inversion that's the problem; it's the uninversion that's much more is a much better signal of economic weakness, which also tends to lead to lower yields. So, Mike, here we are, the Fed talking about cutting rates for the first time since really 2020, when the Fed was aggressively cutting rates to offset the pandemic. And yields have been coming down here. We were near 5%, last year. Now we're down to just barely above 4% this morning, looking to break that level. That could certainly lead lower. And if you take a look at a technical chart of bond yields, that's certainly improving a whole lot. We're potentially breaking some long-term downtrends in yields. That's really starting to bode better for bond prices. What are your thoughts?
Yeah, technically, I think they're starting to look very good here. It looks like yields are going to start coming down a little quicker. They've been coming down, but that pace may accelerate. But again, bonds, I've said this before, bonds can be very fundamental. It's really helpful to look at technicals, but they tend to track the fundamentals. Fundamentals, like Lance just said, inflation and prices, they tend to have a much higher correlation with those. Whereas stocks, the correlation between the price and earnings are all over the place. Some have a decent correlation. Most don't have a very good correlation. Over long terms, they do, but not over short term. So, when I'm looking at bonds, one of the things that kind of gets me excited is that there are a lot of people short bonds. Now that using the word short can be construed many different ways. First of all, there are a lot of just people, like especially institutional investors, that are short the bonds. And as the price goes up, they lose money. So eventually they get forced out of it. And some of those are just speculators that are betting on the direction of rates. A lot of those are, for instance, mortgage-backed security holders that are short treasuries because they're hedging their mortgages. So as mortgages refi and as rates come down, they have to cover those hedges as well. And we've talked about that a long time ago, but you have the potential that a lot of big banks have to cover shorts at the same time. So that can be positive. Then there's another type of short, and it's money managers that compare themselves to a benchmark. Like traditionally, a 60-40 benchmark is 60% equities, 40% bonds. Well, they may be right now 30-35% in 2-year or money market type instruments, earning 5%, more than 5.25%. But if they think that the Fed's going to cut rates and those rates on their 2 years and money markets are going to drop precipitously, they're going to want to lock in 4+% out the curve. So, at some point, somewhat similar to what we saw with small caps and large caps over the last month, people just became too short and they had to readjust. They had to rotate. They had to sell some of their large caps and buy some of the small caps. And so you have that potential within the yield curve. And then I just think there's a lot of people just, not money managers, not people benchmarking, not hedging, just a lot of money in the money markets that's earning 5%. They're very happy. But when they start seeing that rate go down, which will happen as soon as the Fed cuts rates, they're going to try to lock that in for longer time periods. So there's a lot of pent up demand. I think the biggest problem facing bonds is the deficit, and it's a narrative more than it is a reality. Yes, the Treasury is issuing a lot of debt, and yes, the supply of debt has some effect on the market. But also keep in mind that Treasury debt is often very unproductive. And we know that the Treasury debt of the last 5 years, for the most part, has been extremely unproductive, meaning it's not going to kick off benefits. And when that happens, it weighs on economic growth, which fosters lower interest rates. So yes, that the supply of debt is higher than it should be. But when first of all, $500 million of that is interest rates. So when interest rates come down, some of that debt that the Treasury has to issue will alleviate itself. So a little bit of it is circular. But the debt is worth something, 25 basis points, 50 basis points, not 2% like the market is pricing in right now. And I think when you look at inflation, when you look at the economy, I keep saying this, rates are too high, and the Fed will start cutting rates, whether it's slow or quickly, and how the economy responds, we don't know. But rates are too high, and when you start seeing those short-term rates fall, you're going to see more action, more money going into the longer-term rates, trying to lock it in.
So, and again, I want to be real clear here too. We've had a very nice rundown in yields over the course of the last, really few trading days. Yields are very overbought right now. And so don't be surprised if yields pull back a bit. That doesn't change the narrative of what we're talking about. What Mike and I are talking about in terms of lower yields is something that will occur over the course of time. Right. Mostly, next quarters to next few years. Yields will gradually work themselves lower as the economy returns back to its normal growth trend of 2% or less. That doesn't mean in the meantime, if tomorrow we get, or say today, we've got a lot of economic data coming out today, right? So unit labor costs. If unit labor costs come in hotter than expected, we could see yields pop up today. That doesn't mean that this changes the narrative, right? It's just there's going to be data that impacts bonds and yields on a day-to-day basis, which means nothing relative to the long-term trend and fundamentals of where yields will be relative to GDP growth and inflation and declining wages. So again, don't mistake very short-term. I get emails every time yields do one thing or one direction or the other based on some news. I get a bunch of emails from, this data came out today and it was really good. Why are yields down or up or whatever? Doesn't matter. That's just positioning from one day to the next. That is simply just bond traders needing to cover shorts that day, or bond traders going long bonds that day, whatever it is. That has nothing to do with the long-term trend in yields and where we're heading to ultimately. Mike, your comments?
Bonds are a global market too. So every country is trading bonds. Every companies from other countries are trading bonds. I mean, it is an incredibly liquid market, and is moved around by all kinds of investors and a lot of events that are not necessarily U.S. centric. The Bank of England cut rates today, so you may have some British money moving over to the United States to try to capture our rates because they're already now in a rate cutting cycle. So is the ECB. So is the Bank of Canada. So our rates are higher than some of those countries. So, we've talked about Japan before, everything going on over there. So there's a lot that can influence bonds in a very short run. And technicals are helpful. I'm not saying they're not helpful. But when you're looking at fundamentals, economic data comes out monthly at best. Some of it is GDP is quarterly. So you have to kind of have a longer leash, so to speak, and realize that and that's where kind of macroeconomics plays a much bigger role is with bond investing than with stock investing.
Absolutely.
So keep an eye on the trends.
Yeah, and real quick, we're about to hit a break and want to come back. I want to touch on a little bit about, in our chat, a comment came up, and this was actually about that article that you and I talked about yesterday. The Treasury is issuing a lot of short-term debt, but they also issue some longer-term debt at the same time. And of course, there's a lot of people going around saying, that's the Treasury trying to manipulate something. We'll talk about that when we come back from the break with Michael Liebowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So it's interesting, over the last couple of days, I've gotten quite a few emails and things about a recent white paper that was out talking about how the Treasury is manipulating the system and trying to support banks. And we had a comment in our chat window talking about, I thought Yellen was swapping out long yields for long high yields to stimulate banks. This has been part of that narrative. So first of all, just remember that bond auctions are a market. And so if the government wants to issue debt, they have to have buyers. So just like any market, if I'm going to issue debt, I'm going to issue debt in denominations that people want. And there's demand. There's a lot of demand right now, obviously, for very short-term debt. And if I'm the Treasury, I'm like, hey, I want to issue bills rather than bonds because I don't want to lock in high rates for a very long time. Because if I lock in 5% yields for 30 years, I'm going to be paying 5% on interest payments for 30 years. Why would I want to do that? That financially makes no sense. But there is demand for longer duration bonds. So the Treasury is going to issue 10-year treasuries, 20-year treasuries, whatever it is, because there's demand and need for those durations within the economic system as well, even though those yields are higher now and they can refinance that debt at some point down the road. But, it's always interesting because, when something's going on, there's always somebody wanting to pull out a narrative. But, let me go to Mike and just have Mike weigh in on this because he's actually read the white paper probably in more detail than I have. Mike, what were your thoughts here?
So I haven't read the white paper, but I printed it out. It's been sitting here in front of me. It's 29 pages. And one of its authors is Nouriel Roubini, Dr. Doom. So, it seems like he always seems to find the dark side of every argument. But, I've read summaries of it. I've read the abstract. And bottom line is they're accusing the Treasury of trying to stimulate the economy by changing their issuance patterns. And can the Treasury, does the way the Treasury issuance affect the yield curve? Sure. It's every market is supply and demand. And if they're changing supply, it has an effect. But what have we been hearing for the last almost 2 years? There's too much supply. Every Treasury auction is awful. That yields are going up because it was another bad Treasury auction. Well, if there is a problem with supply as the market kind of, is telling her there's too much supply. Shouldn't Janet Yellen be trying to move supply from the troubled part of the yield curve to someplace that can easily absorb it? So, forget the economics. They've been struggling with a market telling them that they're issuing too many 5, 10, 30-year bonds. And what are they supposed to do? Just flood the market with more and push rates even higher? They're trying to get the lowest interest rate possible for the debt. And some of that is, what's the interest rate today? But like Lance, you just alluded to, it's where are rates going? And every economic forecast has a long-term economic growth rate below 2% and inflation at 2% or even lower. That argues that long-term rates are going to be in a 2% vicinity in the future. So why should they lock in 4 to 5% when they can pay a little bit more today, but lock in a much lower rate tomorrow? So I'll read this. I'll read it today or tomorrow this weekend. But before I even get into it, I'm going in with a bad attitude that it just doesn't make sense based on what we've seen.
Yeah, so let me answer a question in our chat. So the question is, if you buy U.S. Treasury today at 5%, do you lock in that yield until maturity because of the price you paid for it? So there's two things when you buy a bond. You have price, coupon, well, actually three things. So you have the price, the coupon, and the yield. The coupon is what you get, right? So if the bond has a coupon of 5%, that's what you're getting paid. Right? That doesn't change. And as long as you hold that bond till maturity, you're going to get that coupon every year until you sell it. Now, the yield is a function of the price and the coupon. So if I buy a 5% coupon at a discounted price, my effective yield will be higher than 5% because I will both get at maturity when that bond matures. So let's just say it's a 1-year bill, right? So I buy a 1-year bill at 90 cents on the dollar, and the coupon is 5%. So if I hold that bond for a year, I'm going to get 5%. So I'm going to get $50 on my $1,000 bonds at the end of the year. But I will also get the price appreciation from 90 cents to what is called par value. That's the face value of the bond, which is 100 cents of the dollar. So even though I only paid 90 cents or $900 for that $1,000 bond, I'm also going to receive $100 in gains at the end of the year because the price I will be paid back for that bond $100. So my yield, my total return will be $150 on that $1,000 bond. So my yield will be much higher than 5% if I could swing that kind of a bargain in the market. So it's always important when you're buying bonds, and I'm going to let Mike go further into this, but it's always important to understand that when you buy a bond, there's coupon and yield, and you should not ever buy a bond necessarily just because of the coupon or the yield. You need to understand the dynamics. I have a lot of clients that come in and they're like, oh, I just bought this bond because it has a 6% coupon or a 7% coupon. That's great. You paid 115 cents on the dollar. Its yield is 1%, right? And that happens a lot, right? So understand the difference between coupon and yield because that has everything to do with what your total return will be at the end of the holding period. Mike?
No, you said that well. Yield to maturity is the yield that you will get over the life of that bond. That yield will come from both coupon and potentially price if you bought it at some other price than par. So yes, if you buy a 6.5-year bond with a 5% yield, you will earn that amount of money, that whatever I said, 5%, whatever I said, over that 6.5 years. Any point in between, your actual yield may differ, and it can differ a lot. But over the life of that bond, if you're going to hold it, you will get 5%. I got my numbers all screwed up, but the gist is yield to maturity is the yield that you will get over the full life of that bond, not at any point in between.
Yeah. And again, like I said, the biggest mistake I see people make all the time, Mike, is they focus on the coupon and not the price. And the price, paying, if you overpay for something, it's just like a stock. If you overpay for the value of a stock, your long-term returns are going to be lower because you paid too much for it. And it's the same thing in the bond market as well. And it's just much more evident in the bond market, right?
And it's actually funny. If we were looking at 2 10-year bonds, they both mature on the exact same day. One has a 5% coupon and one has a 2% coupon, which has the higher potential return. They'll both yield in 10 years the same thing. But if yields go down between now and then and we want to sell it in a year, we're better off with the lower coupon, depending on how much yields go, but better off with the lower coupon because it has more what we call duration, how much potential price change there is for the yield change. So, when you're kind of comparing bonds and you're looking at different maturities and different coupons, there's a lot to it. And, it's not just because it has a very high coupon doesn't mean it's yielding anything more. So always look at that yield to maturity. That's the number you want to look at. And if it's a callable bond, you want to look at what they call the yield to worst. So if I have a 5-year bond and the issuer of the bond can call the bond in 3 years, I want to know what that yield would be if they do call the bond in 3 years. That's the yield to worst. So if that yield is lower than the yield to maturity, that's going to be the yield that I focus on. It's the worst possible yield I can get at maturity, whether maturity is in 3 years or 5 years.
Yeah. And just real quick, we're talking about individual bonds. And in this particular case, it could be corporate bonds, it could be treasury bonds. Bond ETFs and bond mutual funds are entirely different because those bonds, when they mature inside the ETF, they're exchanged for a new bond. So you have rolling maturities and rolling yields and all these type of things. So, ETFs are they don't mature. So like a TLT or an EDV, whatever, if you're long a bond ETF or long a bond mutual fund, those have no maturity date. So when you're looking at the yield, you look at the SEC effective yield on that. That's what it is today. But as those bonds mature, they'll be replaced by other bonds. And that yield, if yields are falling over time, the yield in that bond fund or that bond ETF will fall with the relative yields in the overall market. Now, the price will go up because yields go down, bond prices go up. But you can't look at that bond ETF or mutual fund and say, oh, that's the yield I'm going to get, because that's going to change over time. Mike, closing comments? You got about 30 seconds.
I would just say bonds aren't stocks. They don't whip around like stocks. Yes, they move. Yes, they trade every day. They trade all the time. The price changes, but they're much more fundamental monster than stocks, are more of a narrative type trade.
Exactly.
In general.
No, that's right. So yeah, someday, Mike, we'll do. We've done it in the past, but we'll bring it back and we'll do one of our Bond 101 sessions here on the show one Thursday, just to bring everybody up to date, particularly since bonds are starting to come back into vogue now for people. They're like, hey, I think I want to buy bonds now. Okay.
Help everyone sleep.
Exactly. Just put it on loop. If you're having trouble sleeping, just that episode when we do it will cure insomnia. So, all right, look, have a great day. Be sure and get by the website. Michael Leibowitz's new article is on the website now. Go get that article. It's a great read. Of course, while you're there, got a latest daily market commentary. That's for free. Our newsletter will be out this weekend talking about yield curve uninversions. That's for free. It's all free on the website, realinvestmentadvice.com. Be sure and like and subscribe to the channel, too. By the way, it's free. See you next time.